Okay, so this is chapter 11, homework problem number 1. We're going to calculate the standard cost of input for your 3 different types of product costs. So these are going to be for direct materials, for direct labor, and variable overhead. So in this problem, it's a fruit smoothie shop. And here's where I'm going to start. All the standards are going to give you right here. It says each smoothie requires 1/4 of a pound, that's a quarter pound of mixed berries. And it says which are the expected cost to be $4 per pound. So we will use that for our direct material standard cost. And then for the labor part of it, it says the shop employees are paid $10 per hour. So we also would need to know the input, the standard quantity of input per hour, which that's going to be at the end. I'll show you where they give you that. Then they tell you that the variable overhead cost are utilities and supplies. They've already given you the overhead rate, which is 5 cents per minute. That's your standard price. And then it says that each smoothie is going to take 3 minutes of direct labor time. So to do the direct materials, what you do is you start with your standard input, which is 0.25, that's a quarter pound, and you're going to multiply that by the standard cost, which they gave you at $4 per pound. So your standard cost for direct materials, and this is again for each smoothie, is going to be $1. So for the direct labor, the 0.05, what you do is it takes 3 minutes to make a smoothie. So if you take 3 and divide that by 60 minutes, that's going to convert that to how much of an hour, that portion or fraction of an hour, which in this case is 0.05. If you multiply that by the labor rate of $10 per hour, that gives you a labor cost of 50 cents per smoothie. And then finally, with your variable overhead, the standard quantity is 3 minutes. So if you take the 3 minutes multiplied by the standard variable rate, which was given at 5 cents per minute, that gives you a variable overhead cost per smoothie to be right at 15 cents. Okay, so this is chapter 11, homework problem number 2. We're going to calculate the direct material price variance and the direct material quantity variance. So it's the same data from the first problem, so let's go back and review. We've got, again, that each smoothie takes 1/4 or quarter pound of mixed berries. The standard cost basically for your mixed berries is $4 per pound. They tell you that during the month of June, they purchased and used 1,300 pounds of mixed berries, and the $3.75 per pound is what they actually paid for this. And then it says that they sold 5,000 smoothies during the month. So here's your 3 requirements. They want the direct material price variance, and then you're going to say if it's favorable or unfavorable. You'll do the direct material quantity variance, and again, you'll say the same thing. Is it favorable or unfavorable? And then they want you to combine the two to get the overall variance for your materials. So to do the price variance, remember the price variance is always based essentially on what you purchased. So notice down below you purchased 1,300 pounds. They gave you that number. And then basically you're going to multiply that by the difference between the actual price and the standard price. So the actual price, which is what they paid, which is $3.75, the standard cost, which was $4, the difference there multiplied by 1,300 gives you your price variance of $3.25. Now the reason you're going to say favorable is that you paid $3.75, and that's less than the standard. So you paid better than your standard price. So anytime you can get the actual price that's lower, you're going to always say favorable. So for the material price variance, you're going to say $325 favorable. So then for the quantity or efficiency variance, again, on this one you're going to hold the standard price constant, which is $4, and then what you do is you compare what you actually use with the standard that you should have used. So they gave you the 1,300, which is what you used. The standard quantity, what you do is you take the 5,000 smoothies that you sold and you multiply that by 0.25. Remember, that's a quarter of a pound. This is basically saying if you sold 5,000 smoothies and you should be using a quarter pound of berries per smoothie, this is what you should have used. These are the standard, it's called the standard quantity allowed. So when you multiply that out, this is what they should have used, again, per 5,000 shipments or sales of smoothies. This is how many pounds of berries they should have used. So you put that in here and you compare that, and then you take the difference between that standard and the actual and then multiply that by the standard price. You're going to get $200. Now in this case, the reason you say unfavorable is that you used more than the standard. You used more than you should have. The 1250 is what that's basically the max you should have been using. You use more than that, whether it's waste or bad product or improperly trained employees, whatever. But because you used more than the standard, that's not good. You'd say unfavorable. That's part 2. Now the last thing is you just combine these two And because you have one's favorable and the other one's unfavorable, you just take the difference. So the difference is going to give you 125, and because favorable is more, you're going to say overall favorable. Okay, so this is chapter 11 homework problem number 3. We're going to be looking at your budget variance. And so again, it's the same problem, the fruit smoothie shop. Here's where I'll start. It says the budgeted monthly fixed overhead costs consist of the lease payment, the advertising, the depreciation, and the store Wi-Fi. So what you're going to do is you're going to add all those together to get the total budget. The actual fixed expenses for the month of June, this is what actually occurred, was $1,600. Then it says when calculating the fixed overhead rate, they anticipate selling 4,800 smoothies, and then it says they actually sold 5,000, so that's good. So part 1, to get the budget variance, the fixed manufacturing overhead budget variance, all you do, real simple, you compare the actual cost, which was given at $1,600, to the budget. So remember, the budget would be the $1,000 plus the $250 plus the $125 plus the $80. That's going to give you $1,455. And so because your actual cost is more than what you had budgeted, you're going to say the difference is 145. You're going to say unfavorable. The second part is talking about volume, and in this case it's good because you sold more than you anticipated. That's good, and that means that your volume variance is going to be favorable. And then you can just kind of plug in the links. By producing a quote higher volume, they're going to be able to use their store fixed overhead costs more efficiently. So it's the basic idea of cost behavior. If you have more volume, that essentially lowers your fixed overhead or any sort of fixed cost per unit. Okay, so this is chapter 11 homework problem number 4. This is the requirement 1. And so what I went ahead and did is I went ahead and clicked on this icon, and all the data basically is right here. And in the requirement 1, they're going to want you to calculate the standard direct material cost and standard direct labor cost for each college frame. So again, this is a company that makes picture frames. So over off into this data table, they've got the standard quantity for each input and the price. So to calculate the actual standard cost per frame, all you have to do is multiply. So for example, for the wood trim, which is the first one, if you've got quantity of input is 21 feet, what you're going to do is you're going to multiply that by the price per foot. So you take 21 times 0.30, and that's going to give you $6.30. So that's what you would put in for this first one. For the mats, for the individual picture frames, it's the same idea. You take the 16 mats, you'd multiply by the price per mat, which is 0.04, and that would give you right at 0.64. So that's where they get that number. And then when you get to the sheet glass, same thing, it's 1 square foot, and if it's $1.50 per square foot, again, you multiply 1 times 150, that's going to give you $1.50. And then for the pressboard frame, that's going to be 10 square foot of the standard quantity multiplied by the price, which is 23 cents. That's going to give you $2.30. That's where they get that number. So then you simply just add all these, combine the numbers, and that would give you a total of $10.74. Now regarding the direct labor, it's the same idea. If it takes 0.2 hours to make the product and you pay $14 per hour, all you do is you multiply 0.2 times 14, and that's going to give you $2.80. That's the number you're going to put here for your direct labor. Now on the next slide, I'm going to show you how to approach and solve requirement number 2. Okay, so this is the requirement 2 of problem number 4 with the chapter 11 homework, and you're going to basically be doing the variances for the materials and labor. So for the requirement number 2, it says calculate the wood trim direct materials. It's the price variance, and remember the price variance is always based on what you purchased. I'm going to make a note right there. And then for the quantity variance is going to be based on what you used. So if you look at the formula, notice they start with what did you purchase, and I went ahead and clicked on the data icon down here. So it told you that they purchased 1,050,000 feet is what they purchased, and they paid 38 cents per foot. So what you do is you compare the actual price of 38 cents to the standard price. Now the standard price, you have to go back and it's going to be listed in this icon. I clicked that on the previous slide, but this icon does contain the standard price. So you compare the actual price to the standard, which is a difference of 8 cents. You multiply that by what you purchased, and that's going to give you a price variance of 84,000. Now you're going to say unfavorable here because you paid more than the standard. You always want to pay less than the standard. So because you paid more, you'll say unfavorable. So that's for the price variance. Now on the quantity variance, you compare usage. So notice what you do is you hold the standard price constant. That's your constant, which is 30 cents. And you look at what you use versus what you should have used. Now the problem gave you the 1,056,000. You can just pull that right over here. But for the standard quantity allowed, I'm going to make a note over here. What you got to do is you have to take what you produced, which is 50,000 frames. Make a note, this is again what you produced, and you're going to multiply that by 21. If you go back to the previous icon, they tell you that the standard quantity of input to make a frame is 21 feet. So this is going to give you the standard quantity of feet that you should have been using. So when you multiply that out, you're going to get 1,050,000. So that's what I tend to call my SQ, my standard quantity. So that number goes there. So then you basically take the difference there, multiply by 30 cents, and we're going to have a variance of $1,800. And again, you're going to say unfavorable because you used more than the standard. You were not efficient. That's not good. So in this case, because again, you use more than the standard, you'd say unfavorable. So that's how you do the material variances. Now, for the labor, this is requirement part 3 on how to do the labor. So they want the labor rate and the labor efficiency variances. So starting with the rate, so what you do is you find the actual labor hours, which they give it right here, 11,500. You just plug that in right there. And then what you're doing is you're going to compare what you actually pay to the standard rate. So the actual rate, they actually show you right up here how they calculated it. They took the actual direct labor cost and divided by the labor hour. So it's $13.85 per hour. The standard rate, you can find this number, again, go back to this previous icon and you'll find the standard labor rate is right at $14. So you take the difference, multiply by 11,500, and we're going to get a labor rate variance of 1725. We say favorable here because we paid $13.85. That is less than the standard. We did better than our standard. That's good. By, in this case, 15 cents. So you'd say favorable. Now, for the efficiency variance, again, we're going to be comparing what you used. So the actual labor hours, which was given 11,500, we got that. For the standard hours, you go back to, again, what you produced. I'll write this over here. So what you produced was 50,000 frames. And you go back to the previous standard or icon, it's going to give you the standards. It was 0.2 hours to make a frame. Okay? So you multiply that by 0.2, that's where you're going to get the 10,000. So that's going to be your standard quantity. So you take the difference between that and what you actually used. So in this case, it looks like it's 1,500 hours. Multiply that by the rate of the standard rate of 14. That's going to give you your variance of 21,000. You say unfavorable because you worked way more hours than the standards. You were not efficient. So you worked 11,500. The standard says you should have only worked 10,000. That's not good. So that's why you'd say unfavorable. Okay, so this is the Chapter 11 homework problem number 5. This is the overhead variances. So you're going to be calculating the variable overhead rate and the efficiency variances. I went ahead and clicked the icon. All the data is right over here. So this is about the picture frames. Again, you got produced. They went ahead and give you the rates for the variable overhead rate and the fixed overhead rate. They gave you budgeted fixed overhead, actual direct labor hours, actual variable overhead, actual fixed overhead, and then standard direct labor hours per input. So remember, so in this particular problem, the reason they gave you the quantity basis being the direct labors is that the assumption is that your variable overhead is based on labor hours. So on the first part, to do the rate variance, so what you basically do is so you're going to take the actual rate compared to the standard rate and multiply that by what you actually used. They went ahead and gave you the actual direct labor hours right over here. So 6,500 was given. The actual direct labor rate, they're showing you how they calculated that over here to get 625 per hour. What they essentially did was they took the variable overhead of 40,625 and they divided that by 6,500 hours. That's how they came up with the 625. So you compare that. The standard rate was given at 6 right there. So the difference there is 25 cents multiplied by 6,500 gives you a variable rate variance overhead variance of 1625. You'd say unfavorable because you paid 625. That's more than the standard. That's not good. Now, on the efficiency variance, same idea. You hold the standard rate constant of $6. You're comparing actual to standard hours allowed. The 6,500 was given. You have to calculate the 6,250. So the way you get that, again, is you take what you produced, which was 25,000 frames, and you're going to multiply that by the standard input, which is 0.25 hours. They give you that right here, 0.25 hours to make a frame. So when you do that, you're going to get the 6,250. That's your standard quantity. You compare that to the actual. The difference times $6 gives you your efficiency variance of 1,500. And again, you say unfavorable because you worked more than the standard. That's not good. The last part, I want you to do the fixed overhead budget variance. This one's an easy one. All you have to do is compare the actual fixed overhead, which was given. I'm going to point an arrow. That's given right there. And they gave you the budgeted fixed overhead. I'm going to circle that. They gave you that right there. You just compare the two. And this one, because we spent less than the budget by 2,000, you'd say favorable. That's really all you have to do. Okay, so the last two parts of this you have to calculate is the we went ahead and did the fixed the budget variance already. We also have to do the volume variance. I'm going to show you how to calculate that, and then at the end you just combine the two to get the overall overhead variance. So on this part, this is the last two parts we got to do. They want you to calculate the volume variance. So in that case, what you do is you compare the budgeted fixed overhead, which we already know, which is 70,000, and then you have to figure out how much was actually of that fixed overhead was allocated to production. So we already calculated the 6,250. We know that that's our standard quantity, and so what you do is you multiply that by the $12 per direct labor hour. They gave that number right up there. That's your fixed overhead allocation rate. When you do that, there's where you get the 75,000. That would be, in a sense, based on volume, what you would have allocated based on standards to production. So there's 75,000. You compared the 70 to the 75,000. That's a difference of 5,000. And because again, your budgeted is better than with the allocation, you're going to say that's favorable. And then the last step and the last part, requirement 3, is you're just simply comparing the fixed budget variance, which we already calculated to be 2,000. We said favorable, to the volume variance, which we said 5,000 favorable. You just add the two because they're both favorable, and that's how you'd get the $7,000.